This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian markets are set for a positive start after Wall Street's best CPI day in more than a year. Stocks and treasuries surging on bets that a surprise slowdown in US inflation now puts the Fed rate cuts back on the table. The Bank of Korea is expected to cut its key rate today as the economy slows amid ongoing political turmoil at home and geopolitical threats abroad. Plus, Israel and Hamas agree to pause a war that's killed tens of thousands of people with a deal to free hostages and prisoners as Israeli forces pull back.
And hiding the markets is all really to do with that reaction to the softer than expected inflation data that we got out of the U.S. I mean, it's really interesting because we had cooling even housing prices, and that's been really interesting because we're watching the core CPI very closely, the first step down in 6 months. And the fact that the Fed's preferred inflation gauge, the PCE price index, doesn't put as much emphasis on shelter is a reason that we look at CPI very closely. But given the more surprising to the upside data when it comes to the CPI with really surprising markets, we have seen that easing by the Fed being priced in, that amount jumping in the overnight session.
And also being supported by, what we see when it comes to profitability for the big US banks, right? We know that, despite of these ongoing concerns about what policies we might see in a Trump 2.0 administration and the implications for the economy and Wall Street, so much excitement, of course, when it comes to some of these big financials for Trump's growth agenda. But we already see these big banks ending the Biden years on a pretty high note. Trading revenue surging on some of the swings that we've seen triggered by the jobs numbers, on the election result as well. We've seen deal making ramp up. Executives are predicting more deals and more potential momentum in that space to come as well. So this is now, for the four big banks, the second most profitable year ever in 2024, and that only trails Biden's first year.
Take a look at how futures are trading at the moment. Not a lot of change, but we have seen the S&P 500 now recouping those losses for this year. In fact, we saw those big gains in the banks index gaining more than 4%. And we also saw that big jump in treasuries with the 10-year yield falling by the most since August, given the inflation data that we got. Not to mention the WTI crude is right now around those 5-month highs. But it's really about that picture when it comes to price trends that we've been watching very closely. Take a listen to what the Fed's Austin Goolsbee had to say.
The trend continues to be improvement in inflation. I'm still optimistic for 2025 that we can continue growing and have a soft landing.
We're watching the strength of the U.S. dollar very closely, which fell to a 1-month low after we got the inflation data, recouping some of those losses, though, through the session. And on the other side of that trade, the Japanese yen at that 156 level, we saw a big jump in the overnight session after we heard from the BOJ Governor Ueda really hinting at a rate hike when they meet next week. Still, Nikkei futures not doing much after 5 sessions of losses already. And, of course, the big central bank decision today is going to come from the Bank of Korea. Expectations are for a cut. But when it comes to the U.S. inflation picture, of course, it really has an impact on global markets. We saw the global bond rally overnight. Let's bring in Bloomberg's global economy correspondent, Enda Curran. Enda, so how important are these CPI numbers in the context that we also are getting mixed messaging from PCE data as well?
I think the main takeaway, Shery, was the core CPI reading, which showed an increase of 0.2%, a touch lower than expected. And in fact, the first step down, as you mentioned earlier, in 6 months. And that suggests that perhaps the core disinflation story is coming back on tap. Within that, there were some cheaper costs for hotel stays and medical services taking the sting out of that tail. Headline CPI continues to feel some pressure from energy costs, made up 40% of the gains there, and still some stickiness in like core staples, car insurance and education services and the like. But the big takeaway, the net takeaway from today was that in recent months, the story had been that progress on US inflation had stalled. But these numbers for December suggest that perhaps there is some easing in the system now, especially shelter prices increasing at a slower pace, giving encouragement that the inflation story might be a bit better as we start the year.
And how much of a threat to this disinflationary story could incoming trade tariffs be?
Well, it's certainly one of the big talking points, the big uncertainties, because much depends, Heidi, as you know, on the breadth and the level of the tariffs which the new president will implement. We don't yet have specific details on that. Our colleagues have been reporting some of the proposals that the incoming administration are looking at. But either way, as soon as we start to get a handle on that trade policy, the economists will start to run the number. And at the margins, that for now they say that if you are going to put up tariffs on consumer goods coming to the US, that will add broader inflationary pressure into the system at a time when we don't still know if the disinflation story is back on track or not. So there's plenty of uncertainty when it comes to trade policy and how it will impact inflation and, of course, by extension, then interest rates.
Yeah, we have seen the pricing of Fed easing really increasing when it comes to year end and how much the Fed can actually cut rates. It's been really interesting to see the bond market reaction as well, because it's been really outsized in the last few days. How will this really feed into other global economies? We have seen UK inflation data also moderating.
Well, we've had a very whipsaw few days on the bond market, as you know. We started the week with yields surging. The story was all about bond vigilantes, and now we had this good US inflation data, and of course it's taken the real sting out of the march up in yields. But there's no doubt that this easing of US inflation has taken pressure off the rest of the world as well, because it does suggest that perhaps maybe the Fed might have some scope to ease again at some point this year. Now, remember, last week, the jobs numbers were so strong that some on Wall Street, like Bank of America, were talking about the Fed having to raise interest rates again. And obviously, that wouldn't be good news for the rest of the world, and especially emerging economies. So this inflation data today suggests some reprieve. And if the Fed has scope to cut, well, then obviously that's going to be good news for emerging economies elsewhere too.
A Bloomberg Global Economy correspondent and Karen, there's so many ripple effects from what the Fed might do this year. Well, our next guest says the biggest risk to US stocks is a further upside in yields. Katrina Dudley is a senior public markets investment strategist at Franklin Templeton. Katrina, great to have you with us. And how much sort of reassurance do you get from this CPI reading? And does it potentially kind of still risk being derailed depending on what the fiscal picture is for this new administration?
I think there's a lot going on at the moment. The first thing, as you've identified, is that the CPI data did come in slightly lower than consensus was expecting, and that's a positive, particularly as you balance that across the jobs data that came in, with more encouragement in terms of the signs of economic growth. And so the Fed is kind of walking a tightrope and doing a good job walking that tightrope, ensuring that they, cut rates when needed and do those adjustments. We're not in the camp that they need to do significant adjustments going forward, but yields are the biggest risk. In addition, the other risk that we see to markets going forward is earnings growth. The banks have delivered strong earnings, and that makes us positive as we look at the markets going forward.
And the other part of the equation, or part of the equation, as you said, there's a lot going on when it comes to these factors, is earnings. Obviously, the big banks, did very well at the end of the last 4 years of the current administration. The banks don't kind of, fully reflect what we see elsewhere, right? Do you see a consistent sort of positive picture when it comes to earnings, or is it going to be pretty spotty outside of, banks and obviously tech?
If I look at the Magnificent Seven and going through earnings, the 12-month period ending September, they actually grew earnings 54%, and the rest of the market was down 2%. So, big tech delivered the majority of the heavy lifting as it relates to earnings growth. As we look on a forward 2-year basis, one of the things that we've noticed is how the breadth of earnings growth is going to expand significantly, so that the big tech won't be covering the full weight of the need to lift earnings growth for the entire market. We see earnings growth happening in the small cap space and in the mid cap space. As we look across industries, we actually have all industries on a 2-year basis delivering forward positive earnings growth. And I think that breadth and the expansion of the breadth in the market is positive, because it means that people won't be as focused on those Magnificent Seven and the fact that they are a very concentrated part of the market. I think it's now time for the other 493 stocks that make up the S&P 500 to start delivering.
Very concentrated also in terms of U.S. investing, given the American exceptionalism narrative that we've seen in the past couple of years. But how closely are you watching at, say, emerging economies going into 2025 and next year as well, with an incoming Trump administration that continues to threaten tariffs?
You're right. In 5 days, we have the new president. And at that point, we are looking at his day one policies as it relates particularly to tariffs as well as to immigration. On tariffs, there's the narrative that he's put out in terms of fairly aggressive tariffs on both China and other parts of the world. There's a camp that believes that you should take him at his word and that those tariffs will be implemented. There's also a camp that says that this is a negotiating tactic and that he will implement tariffs that are less significant. The biggest concern as it relates to emerging markets is the impact of those tariffs. I think in terms of China, if we have a look at the percentage of exports that that China has into the United States, that's declined by 47% since the first round of tariffs were implemented during the first Trump administration. And so the exposure there is much less significant, and that's something that we think investors are not taking into account. The second side of tariffs as it relates to the inflation, and that obviously has the follow-on effect in terms of what the Fed does in terms of rates, is we don't think that there's any discernible proof that shows that there's a direct connection between tariffs and inflation. And if you have a look at the tariffs that were implemented in his the last time he was president, you've got the evidence to show that there wasn't a significant increase in inflation. And so we are a little more cautious that these tariff regimes are going to really hurt the U.S. consumer.
And the impact also on specific industries like semiconductor, right? I mean, Northeast Asian economies depend a lot on these hardware exports. We do have the Bank of Korea rate decision today to contend with as well. How much more difficult and challenging does the situation become for economies like this that are very trade dependent?
Yes, you're right. 92% of semiconductors come out of Taiwan, and I think that there's been a deliberate policy in the United States and even internationally in order to start diversifying the sources of semiconductors. I think that that's just good for business, it's good for defense, and a number of reasons. That just takes time, and luckily we have already started down that journey. As it relates to these emerging markets such as South Korea, I think that it is a headwind for them, but I don't think it's a headwind that they can't overcome. I think that they've had a sufficient knowledge of what is happening and that they can make appropriate adjustments. We saw, for example, in the washing machine market, when we had significant tariffs introduced in the United States, a number of these companies actually were domiciled in, say, South Korea, moved manufacturing into the U.S. so that you had the jobs creation in the U.S., but you actually had the profits going back to the Korean companies. And I think that we could see something like that happen again.
Katrina Dudley, great to have you with us, public market senior investment strategist at Franklin Templeton. Coming up on the Asia trade, UBS tells us why they see favorable trends for stocks with pullbacks as a buying opportunity. Plus, it's BOK decision day, and Goldman Sachs joins us to explain why they expect a rate cut. And a closer look at earnings for the big U.S. banks as they close out the Biden era with a surge in profits. This is Bloomberg.
"700 days of failure and 1 day of success." Well, we've had many difficult days since Hamas began its terrible war. We've encountered roadblocks and setbacks. We've not given up. And now, after more than 400 days of struggle, the day of success has arrived.
President Biden there speaking about the deal to bring a temporary halt to the war in the Gaza Strip. Let's get some more details now when it comes to the ceasefire deal, the reaction. Our Bloomberg editor Michael Heath is with us. And, I suppose in a lot of ways it's obviously positive that's been done. It's hard to kind of look at this without the context of just how much life has been lost.
Yeah, I mean, it's a real issue, Heidi, because this is the deal, from what we understand, is very similar to what was on the table in August. And since then, you've had, thousands of people killed. You've had Israeli soldiers as well killed. Very little progress made in the war, and it really does raise the question of what was the difference between now and then. The difference seems to have been the election of Donald Trump, and basically, Israel having potentially the most pro-Israeli president in history there, that they really don't want to get off on the wrong foot with him. So they're just going to take this plunge. I mean, as you say, it's only a temporary agreement. It's 6 weeks. 33 of the hostages are supposed to come out, and Israel will withdraw from sort of the more populated areas, and it'll release a swathe of Palestinian prisoners as well. But whether it holds, I guess, is a question. But then what more Israel expects to get out of the military campaign is another issue as well.
Well, because there's a lot of tension from already settlers in specific areas, and whether a two-state solution is still viable or wanted, by the parties. Is there any kind of indication of what that could look like under Trump foreign policy in the Middle East?
Well, Donald Trump, in his first term, he actually got pretty ambitious about what he wanted to do in the Middle East, him and his son-in-law, Jared Kushner. And they did sign these Abraham Accords, which, formalise relations between Israel and some Gulf states. And the big prize is basically doing that between Israel and Saudi Arabia. Now, the Saudis basically obviously want peace in Gaza. They also want, the Palestinian Authority to replace Hamas and to be reformed and to sort of be running things. They're prepared to put in some money to rebuild Gaza, but there also has to be a path to a Palestinian state. And the idea that Prime Minister Benjamin Netanyahu is going to agree to that is very hard to see. But then you do have the unpredictability of Donald Trump, which is almost like sort of throwing a stone in the pond and seeing what waves come out of there, because surprising things have happened. I mean, we saw the fall of the regime in Syria, which had been there for 40 years. I mean, all sorts of amazing things are happening in the Middle East now. So it could go very bad, it could go very right. It's just really unclear, but the precedents aren't particularly good for it to see a solution there.
I was going to say, how different is the landscape now from Trump 1.0? In this new administration, you mentioned the fall of Bashar al-Assad's regime and how Iran has been humbled when it comes to its role in the Middle East.
Yeah, that's exactly right, Shery. And the question sort of is, on one hand, it's opened up a lot more possibilities, but also when Trump was first there, Iran was the great threat to everybody in the region, whether it's Israel, whether it was the Gulf states as well. They were all worried about its power. And so it sort of naturally had that drawing together effect. Now things have sort of dissipated a bit in terms of power, and there's a reorganisation, a recalibration of who is the sort of the senior country in the region as well. And there's a lot of jockeying for power there, whether it's Saudi Arabia, whether it's Turkey, whether it's Iran trying to hold on to what it has. So it's sort of unclear, how the pieces might come together again is not particularly clear. But definitely, I think all parties are interested in this whole idea of a Saudi-Israeli deal. And of course, the prospect of that deal is actually what spurred Hamas to launch the attack on October 7th in 2023. So it's significant for all players involved there, and that's the prize. I mean, you do that, or if you get some sort of peace deal here, you could see President Donald Trump winning a Nobel Peace Prize or something to that effect. I mean, but again, there's a lot of bridges to be crossed here to get to that point.
Bloomberg's Australia and New Zealand eco-editor Michael Heath there. Now, the U.S. unveiled a fresh round of regulations aimed at keeping advanced chips from making their way to China. Beijing has called the Biden administration's flurry of trade restrictions on its final days in office irrational and irresponsible. For more, let's bring in our China correspondent, Min Lo, in Hong Kong. Min, so what are these latest regulations?
Hey, Shery. So these are latest rules that will require chip makers like TSMC, Samsung, Intel to step up due diligence of their customers. The U.S. is expanding licensing requirements for these foundries and packaging companies, with tighter rules being applied unless these customers are trusted customers that are able to prove that their processes are below a certain performance threshold. And the U.S. is also imposing sanctions on 6 16 Chinese companies. And the intention here is to close the back door that could allow some advanced semiconductors to enter China, because in the past, last year, for example, some of TSMC's chips somehow were able to find their way into Huawei's AI servers, and that's precisely the sort of things that Washington doesn't want to see. And of course, this comes, as you said, after a series of measures over the past few days, really a last-ditch effort by the Biden administration to tighten the noose on China's access to semiconductors.
We've sort of talked a little bit about clearly a displeasure from Beijing in terms of a response. And, you know, I guess it sort of highlights how critical this pursuit of self-reliance is.
Yes, that's exactly what China had said. They had, of course, blasted the move, saying that it's irresponsible, but they also vowed to double down on their self-reliance push. And as I said earlier, we have seen, for example, the U.S. blacklisting Chinese tech companies like Tencent, blocking the sale of smart cars containing Chinese software and hardware, banning NVIDIA chips from being sold to most data centers around the world. So really, every few days, we've been getting new measures from the Biden administration. Markets really gearing up for potentially more tensions between U.S. and China, especially as Trump takes over the reins from Biden, and with potentially more tariffs coming for Chinese goods as well.
Bloomberg's China correspondent Min Min Lo there with the details. More ahead on the Asia trade. This is Bloomberg.
Haidi, we're gearing up for a potential third consecutive rate cut coming from the Bank of Korea. Now, we haven't seen this type of easing streak since the end of the financial crisis, when the BOK had to cut about 6 times, and all to do with, of course, the weakening economy. And the BOK might have room to cut. I mean, Haidi, you and I have talked about the challenges of South Korea, especially given very high levels of debt and the financial instability that a lot of easing could cause, given housing prices surging. But household loans have fallen, so that gives the BOK a little bit more room. Not to mention that we also saw that surge in the jobless rate, surprisingly, so this week, which could also lead to the fact that the BOK might feel more pressure to ease. And of course, I haven't even talked about the political crisis over there.
That's right, and it's quite interesting. You know, if you take, in some sense, you would think that they're separate things. Obviously, we had the terrible disaster from the Jeju airline crash and this ongoing political saga, but quite clearly, and in the views of many economists, including here at Bloomberg, all of that is feeding through to kind of a broader confidence blow to the South Korean economy at a time where we're already seeing structural weakness, and we've seen that play out when it comes to those jobs numbers that you just mentioned, and potentially just sort of broader consumer and household confidence there as well. And you mentioned this ongoing political situation, and we are expecting that resumption of questioning of President Yoon at 2 p.m. local time. That's according to the recent reporting from Yonhap News. He had asked the investigation office to delay the morning questioning, citing health reasons. He had been questioned for about 10 hours, over 10 hours on Wednesday, and has been detained at the Seoul Detention Center for those questions. So we'll see if there is yet another refusal to testify today. Let's take a look at how commodities are trading this Thursday morning. This, of course, we had that really reassurance when it comes to the US CPI print, suggesting that that deflationary mindset has kind of taken hold. Of course, still a lot of question marks over how the fiscal situation, trade tariffs in the US this year could impact that. This is a picture, though, as we continue to see those highs being held at around that 5-month high when it comes to crude, Russia sanctions, US supply declines continuing to play out, though. The numbers in particular when it comes to tightening US inventories have has really pushed a bit more of that price momentum for crude, and these ongoing sort of tightening of restrictions and sanctions on Russia also impacting some of those flows as well. We're seeing iron ore actually seeing a little bit of upside at the moment. In fact, just over 1% of upside for iron ore, despite these ongoing concerns when it comes to China's growth. But we did see iron ore shipments from one of the biggest ports here in Australia, Port Hedland, reaching a record number in 2024, Shery.
Heidi, let's go a little bit deeper on that agreement between Israel and Hamas to a phased ceasefire deal to bring a temporary halt to the war in the Gaza Strip. Joining us now is Mara Rudman, professor at the University of Virginia. Mara, great to have you with us, and thank you so much for joining us today. This seems like a big diplomatic victory for President Biden in his outgoing days. Only 5 days for President Trump now to take office. Though, how big of an effect did the former president have when it came to actually getting this deal into place?
Well, I would say first, it's a victory not just for American leadership, but really for the Israeli people, for the Palestinian people, for leaders in the region. So it's an important statement across the board, and so very much needed to get to this temporary ceasefire agreement with a very good chance of moving from the first phase to the remaining phases. You're right, Shery, that there was a clear partnership, and that may seem odd for people to hear given the very significant rough spots between the Trump teams and the Biden teams. But this is something that the way in which they work together, and particularly President Trump's named envoy for the Middle East, Steve Witkoff, who really kind of took up residence in Doha, understood that the Biden team was the lead, but contributed in key ways because he understood that he was going to be carrying on the responsibility of implementation. So this was a handoff between administrations that should work this way on all national security issues. But with these teams, it was clearly a rare occurrence, and very fortunate that it has played out this way.
Given the relationship between Prime Minister Netanyahu and President Trump, how are we expecting the negotiations to unfold in the coming months?
Sure. Well, it's been reported that President Trump's named Middle East envoy, Steve Witkoff, who I mentioned a moment before, who has been in Doha, flew to Jerusalem to meet directly with Prime Minister Netanyahu, I believe on Shabbat, there on Saturday, with, again, President Biden's, one of President Biden's top aides, Brett McGurk, on speakerphone for a conversation that I am guessing conveyed the fact that President-elect Trump and President Biden were of one mind on the importance of getting this deal done, getting it done now, getting it done on the terms that had been laid out. And so I think what Prime Minister Netanyahu can expect is a continuation in terms of the commitments that are being made in this framework to work towards negotiating in this, once the first phase is underway, negotiating a permanent ceasefire, which is a key part of this deal, continuing humanitarian assistance going in, continuing the hostages coming out and the Israeli hostages coming out, and the concurrent releases of Palestinian prisoners from Israeli prisons. And in addition to that, working towards the phase 3, which is really the very serious reconstruction effort that is required in Gaza, I would say is required for Israel's security and stability, as well as for that of the Palestinian people. And so figuring out together the details of how that occurs. And so President Trump sharing some of the credit for this this achievement, though I think that the large amount of it goes to President Biden and his team, but sharing in this partnership, he also owns working it through in the remaining phases of the agreements. And I think that's very important, and I think it was a wise policy decision on his part.
And at the moment, we're also seeing this Global Alliance meeting, as we see building international support continue for a two-state solution. I do wonder for the parties and for the major power brokers, including the new Trump administration, how viable is that model now, and is that wanted by both or each party?
Yeah, well, I think, and Tony Blinken our Secretary of State has laid out that it is a requirement to get to the kind of security and stability that Israelis so desperately and understandably desire, that so many Palestinians want, that the rest of the region demands. And that is going to require finding a pathway to a Palestinian state that sits alongside a state of Israel. That doesn't mean that negotiations start tomorrow. That's part of why the reconstruction effort in Gaza is so important, what the role will be of the Palestinian Authority there, how to work the very serious security issues that will exist, how much international actors will come in both with resources and probably in the very needed way to help secure the ground in Gaza. All of those things are really tough issues, but are critical for security and stability, again, for the region and for countries throughout Europe, in the United States, throughout the world. And so there should and there will be, I expect, an international effort to make that happen.
Alongside the ongoing conflict in Gaza last year, late into last year, we had some astonishing developments in the Middle East, right? The complete, sort of transformative developments in Syria, the reframing of perhaps Iran's capacity and confidence in the region. Do you think that speaks to the possibility for more uncertain developments this year, or does it perhaps give policymakers maybe a bit more confidence to think outside the box that, more might be possible in this region to affect change?
Sure. Well, both things can be true at once. That it will, I expect, lead to or contributes to uncertainty about the region in the coming year, and also opens up opportunities. To be clear, one of the opportunities that opened up, the terms of this ceasefire in Gaza, are largely those that were laid out by President Biden last May. And negotiations have continued, have had their ups and downs over these months, but it's likely that the extent to which Hamas was isolated by the actions that Israel took with respect to Hezbollah, and then the subsequent ceasefire, also negotiated by the Biden administration, between Hezbollah and Israel, the ways in which Iran was both struck, the back and forth between Iran and Israel, and the fact that Iran was seriously weakened, including weakened by the fact that it no longer had Hezbollah, is what significantly contributed to the downfall and the very fast downfall of Assad in Syria. So these are all interrelated. Iran is probably at once both at one of its most weak states that it's been at in years, and at the same time probably working that much more intensively to increase its capacity to make a nuclear weapon. So that in itself leads to a volatile situation, and other actors in the region are really keen to ensure the United States is ready to partner in ways that increase stability and security. And some of those interests are also shared, I am sure, by President Trump and his team, who do not want to see the United States significantly involved, drawn into further conflicts in the region. And so there are new opportunities, new arrangements, and some very tough decisions ahead for President Trump and his team.
Mara, it's always great to have you with us and your insights. Mara Rudman, professor at the University of Virginia. Well, just days to go. President Biden is set to deliver a farewell speech in about 2 hours' time. His administration coming to a close ahead of Donald Trump's inauguration on Monday. Bloomberg's political news director Jody Schneider joins us now from Washington. Of course, there's been a flurry of, sort of last-minute achievements and policy measures from the outgoing administration. What are we expecting from his speech?
Yeah, Heidi, we expect that he is going to tout economics, the job growth that has occurred during his administration, and getting things back on track. When he took over, of course, it was right in the midst of COVID. People were still all working from home. There was really great kind of economic dislocation, supply chain problems. And though a lot of people voted against him based on the economy, he is going to tout that and legislation that really helped improve the economy, the whole Build Back Better plans. So we expect he'll do that. We expect that he will mention the anticipated release of hostages and the ceasefire in Gaza. We expect that he will talk about that and that he was able to get that done. It's expected to be a short speech, about 15 minutes, but really a farewell speech with him saying he thinks he has done some important things and left the country in better shape than when he took over in early 2021.
Yeah, I mean, as Heidi alluded to, we are seeing a lot of activity just in the last few days before he leaves office. He's not trying to go away quietly at this point.
That's right, Shery. Even though after the few months after the election in November, we didn't really see or hear from him, too much. But the last few weeks have been a flurry of activity, passing some bills. Some say he's trying to Trump-proof things like energy regulation and trying to do some things that perhaps the incoming president will undo, but trying to make, his case for some of his policies, and a lot of announcements and a bunch of goodbyes. This one, of course, more significant in that it's from the Oval Office. It's an actual farewell. But he has, had a lot of these kinds of speeches. He had a foreign policy speech on Monday, and this one will be a little bit of foreign policy as well, given the announcement today of that ceasefire that they hope will take effect very soon in Gaza, and those hostages being released. He does leave with a pretty low opinion rating, approval rating, 36.1%, which is the lowest since any president since Jimmy Carter.
Bloomberg's political news director Jody Schneider there. And other geopolitical stories that we're following at the moment, Canada is said to be preparing to put tariffs on about $105 billion worth of U.S.-made goods if Donald Trump carries through with his own trade threats. Our source says the list will only come into play if Trump moves first and may be expanded later, depending on what the U.S. does. Prime Minister Justin Trudeau has met with the premiers of Canada's provinces to discuss the tariff issue. The Washington Post is reporting that President-elect Donald Trump is considering an executive order suspending the looming U.S. ban on TikTok. The app is set to go dark in the U.S. from Sunday unless it's sold by its Chinese owner, ByteDance. The Post cites unnamed sources saying a Trump order could suspend enforcement of the law for up to 90 days after he's inaugurated on Monday.
Shery, the biggest US banks are ending the Biden years on a high note, with their combined quarterly profits so far topping $100 billion. We'll be taking a closer look at those earnings next. This is Bloomberg.
Four of the biggest banks in the U.S. ended the Biden years on a high note, notching their second most profitable year ever in 2024. JP Morgan became the first bank in U.S. history to top $50 billion in annual profit. Citigroup also saw three of its five main segments, wealth, U.S. personal banking, and services, posting record revenue for the year. Bloomberg's Sally Bakewell joins us now for more on this. And Sally, despite all of the excitement about potentially more growth coming during the Trump era, we have seen a very positive finish for 2024 in the Biden years. What stood out for you?
I think the very big takeaway here was the trading performance by a lot of the banks. This was a great quarter for Wall Street's traders, with both JP Morgan and Goldman scoring some kind of record as they capitalized on the election volatility. Goldman was able to cruise past estimates, and its equity traders delivered their best year on record, and it helped it double its fourth quarter profit to more than $4 billion. JP Morgan's traders also notched a record fourth quarter. And even Citigroup, it soared today and actually led the pack for a while, despite lowering a crucial profitability target. I think investors really liked the fact that it announced a $20 billion buyback program and also managed to notch records in three of its five units: services, wealth, and U.S. personal banking. So all in all, it was a strong quarter, and that optimism also bleeds into next year.
Yeah, and there were already optimistic expectations for next year as well. What are they sort of hoping for, particularly when it comes to the regulatory side?
I think the incoming Trump administration is widely expected to pare back, repeal, get rid of some regulations that had shackled the banks from doing the sort of M&A, the jumbo deals that really burnish their bottom lines. Regulators are also expected to dial back or get rid of potential new capital rules, which would free up a lot of capital for these banks, indeed to return it to shareholders or to do more profitable activities, such as lending or other more risky activities. So there are some headwinds, however. Of course, Trump's tariff policies, however they actually take effect, could lead to inflation, which would be bad for borrowers. But the rate cuts, on the other hand, if those take place this year as well as expected, that could also be a big boon for banks by encouraging borrowers to lend, which of course generates more lending income for them. So a lot of things are pointing to a strong 2025 for a lot of these banks. And I think that was reflected in their share prices today.
Bloomberg Sally Bakewell there. Let's take a look at one of the other stories that we're following. And Hindenburg research founder Nate Anderson says he is shutting the short-selling firm. In a post on the Hindenburg website, Anderson said there's no specific threat, health or personal issue behind that decision. The firm's first high-profile report came in 2020 against electric truck startup Nikola. It was most recently known for that 2023 report against the Adani Group. Hindenburg has also gone after major financial figures, including, of course, Carl Icahn. So, this is quite an interesting development, right? Because this has really been something that, Shery, has been so market moving. We, in particular, when it comes to these sort of broader moves on the Adani empire, was really this sense that this was a sign that Hindenburg in its targets was really going global in, some of the companies and the individuals that it was retraining its focus on. They've talked about that brazen market manipulation, according to them, by the Adani Group at a time when that group had been really trying to attract global and retail investors. And we saw just the enormous amount of fallout there as well. So it's pretty interesting. And it, in a way, I guess it leaves a great sense of relief for a number of companies.
Yeah, Heidi, I mean, it's interesting to put in the broader global markets picture, right? With the huge stock market rally that we've seen, it's been very difficult to be a short seller, not to mention the rise of retail investors, the likes of GameStop being a huge meme stock as well. So we have seen a lot of other short sellers also sort of retreat from this field, the likes of Jim Chanos, for example, closing his short-focused funds back in November of 2023. We now know that the defunct Melvin Capital lost $1 billion in a single day, given that huge surge in what I mentioned before with the GameStop shares. So it's been really interesting to see these activist short sellers sort of starting to retreat from the area. But before Anderson focused on short selling, he really was trying to earn a living by submitting tips to the SEC whistleblower program in order to collect some rewards. He then poured his energy into publishing reports online. He now says that he'll try to make a series of models and materials on Hindenburg's model so others can learn from that. But as we continue to watch the markets, take a look at some breaking numbers that we have out of Japan as well. We're getting the producer price index month on month, a gain of 0.3%, surprising to the downside. The expectation was for gains of 0.4%. Year on year is growth of 3.8%, which came in line with estimates. Of course, very important, as we have already seen corporate goods prices accelerating to the fastest pace in 16 months for PPI numbers in the previous month, which sort of supports the BOJ's further normalization of policy and puts this pressure on companies to pass on costs to their customers. So we continue to watch the PPI numbers very closely. When it comes to the month-on-month number, a little bit of downside surprise of gains of only 0.3%. We have more ahead on the Asia trade. This is Bloomberg.
This is the Asia Trade. The latest when it comes to some of the corporate headlines that we're following. SpaceX has launched a pair of commercial satellites carrying lunar rovers as competition intensifies in the private sector's race to the moon. One probe is made by Texas-based Firefly, which will attempt landing in about 45 days. The other is from Tokyo-based iSpace and is scheduled to reach the moon around the middle of the year. Meanwhile, Blue Origin says it's targeting Thursday at the earliest for the twice-delayed debut launch of its New Glenn rocket. Bloomberg sources say Blackstone has hired financial advisors to explore the sale of song rights that might fetch over $3 billion. A deal could include music from Bob Dylan, Adele and Ariana Grande. Our sources say financial firms including Apollo Global, Warburg Pincus and Temasek have all expressed interest in these assets. TSMC is expected to post its fastest pace of growth in profits in 2 years on Thursday, reflecting the growing dominance of high-end chip-making and AI development. Analysts on average expect net income to increase 55% on year. TSMC last week reported quarterly sales that topped estimates, reinforcing investor hopes of another strong year for data center hardware spending. And you can catch our exclusive interview with the Intercontinental Hotel CEO, Elie Maalouf, as the luxury brand celebrates its 50th anniversary of entering the Greater China market, the opening of its 800th hotel in the region. Taking a look at some of the challenges and opportunities. That's at 1:40 p.m. Hong Kong time, 4:40 p.m. in Sydney.
And Heidi, these are some of the stocks that we'll be watching when trading opens in Korea and Japan. We'll be tracking Takeda Pharmaceutical after the FDA announced a ban on red number 3 citing cancer risks. We know that this is found in drugs including Takeda Pharmaceuticals for disorders like attention deficit hyperactivity. Also keep an eye on retail stocks like J-Front Retailing after tourists to Japan hit record 37 million in 2024. This, of course, given the decline in the Japanese yen, which is making the country an attractive and affordable destination. In South Korea, we'll be tracking Naver after Webtoon announced it plans to have Japanese web comic studio number 9 as part of the comic company's global expansion strategy.
Coming up later, Shery, we'll be, of course, giving you live coverage of President Biden's farewell address as we count down just days now until that Monday inauguration of President-elect Donald Trump. Market opens in Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after the surprise slowdown in U.S. inflation. Haidi led to stocks and bonds to gain ground in the overnight session. More conviction that the Fed will be able to continue easing rates this year. But of course, here in Asia, we're firmly watching the Bank of Korea.
So much pressure when it comes to the South Korean economy and, of course, such a fragile balance when it comes to the downward pressures on the won as well, Shery. But at this point, the Bank of Korea doesn't really have much choice other than to provide more support.
Yeah, we are expecting that rate cut to come from the Bank of Korea today. That would be the 3rd consecutive rate cut this time around, and also the longest easing streak since the financial crisis when they had to cut 6 times. So what we're watching is also the Bank of Japan, because we actually heard from Governor Ueda talk about the possibility and hinting at the possibility that there could be a rate hike next week, which is why we saw this strength in the Japanese yen that continues at the moment at that 156 level against the U.S. dollar. You're seeing also Japanese stocks rebounding from 5 sessions of losses already. We'll continue to watch Japanese yields as we had even the 40-year yield rising to record high given the global bond sell-off. A little bit of a reversal overnight given that we saw treasuries recouping losses, not to mention global bonds also with gilts rising. But take a look at what South Korea is doing at the moment. As we mentioned, we are expecting the rate cut to come from the Bank of Korea. We have seen a little bit perhaps more room for the central bank to act given the household loans have fallen, not to mention that we are now seeing more pressure on the economy with that surprise gain in the jobless rate this week as well. The Kospi gaining ground for another session and extending those gains that we saw in the previous session. Same with the Korean won, strength at that 14.54 level, Haidi.
Yeah, take a look at what we're watching when it comes to trading here in Australia. This is a picture with a little bit of upside, 1.6%. Watching the banks in particular, we had such strong carry through when it comes to the US banks off bumper earnings to end out 2024 and really to end out the 4 years of the Biden administration, right, with more upside expected to come with looser regulatory conditions being one of those expectations going into the next 4 years of the Trump presidency. We are seeing the Aussie dollar seeing a little bit of upside there as well. We do have some more eco data coming out a little bit later on today that we'll be watching out for, and whether that kind of influences what we could see for the RBA will be something that we'll be watching today with those jobs numbers, and watching treasuries as well as we see a little bit of a calming when it comes to the bond markets, of course, on account of this sort of, finally disinflationary impact perhaps taking hold. That core CPI number was the first step down that we've seen in about 6 months. And we heard from actually a trio of Fed speakers, from John Williams to Austin Goolsbee, really talking about the fact that we are starting to see these price pressures come off. Take a listen.
The trend continues to be improvement in inflation. I'm still optimistic for 2025 that we can continue growing and have a soft landing.
Our next guest believes that underlying trends still remain favourable for stocks and sees US equities as being attractive. Let's bring Suresh Tantia, who's the APAC strategist and CIO at UBS Global Wealth Management, I should say. Suresh, really great to have you with us. And so how reassured are you by this one CPI reading that suggests that we are seeing that sort of underlying momentum come off, particularly some of the stickier elements of US inflation? Does that give you a bit more optimism about what the Fed might be able to do?
This is certainly a very encouraging news because over the last few weeks, markets have been under pressure on inflation concern. And now it seems like we are in a Goldilocks scenario where growth is holding up. At the same time, inflation is not such a big concern for the market. And the equity market thrives on growth. So as long as growth is strong, I think the equity market can recover all the losses that we have seen over the last few weeks and could reach to a new high. So I think the economy is in a great shape. Earnings this year should be up close to 10% for S&P 500 index, and that will lead to S&P rising to 6,600 by the end of this year.
And of course, it's not exactly an even market, right? And we've seen the magnificent stocks and in particular now some of the big banks there as well. Would you be looking at some of the sort of underheld names and themes, or do you still think it's going to be a market driven by AI, by sort of the chip theme?
AI is going to be a story of the year. If you look at the capex by the big four tech companies in US, it would be up 25% this year. So very difficult to see major underperformance of the tech stocks. We think they can still go up by 15% in 2025. But at the same time, some of the cyclical sectors like financials, we do expect them to do well, especially given the result we saw overnight from two banks. I think valuations are still reasonable. Growth is going to hold up, and that's going to drive some of the earnings and the stock prices for bank names.
Does the momentum that we're seeing, talking about AI and tech earlier, does that momentum mean that will translate to Asian stocks as well, especially around hardware names, around semiconductors in Northeast Asia?
We have been seeing that. If you look at Taiwan, which is one of our favorite market in Asia, it has done very well last year. And we do expect the earnings of the tech companies in Asia to rise substantially this year, especially on the AI plays. So I think Taiwan is in a great space. I would be a bit more cautious on the Korean tech names because those are more legacy stocks, and the legacy hardware has been under pressure because of weak demand for electronics, computers, etc. But the Taiwan stocks, I think they are going to do well given the very strong growth outlook for AI.
When it comes to Asian nations, of course, we're also contending with Fed policy. And although we are seeing a little bit of a breather from just surging Treasury yields, what does this huge reflationary risk that we're seeing around the U.S., around other parts in the world, mean for central banks across Asia and what that might do to the stock markets as well?
It's been a concern for Asian central banks and also the Asian markets, because the way the higher treasury yields impact Asia is via the currency angle. Because of higher yield, dollar has been stronger, Asian currencies have been coming under pressure, and that's why there have been pressure on the Asian equity markets as well. So yesterday's inflation print is very good news. As a dollar seems to be stabilizing now, it's quite possible that Asian currency also stabilize, and with that, it will provide room for Asian central banks to cut rates and be positive for the Asian equity market. End of the day, I think what matters is the growth outlook. And growth outlook for the region still remain quite optimistic. If you look at the PMI numbers across the board, they have been above 50. And that's going to drive 10% earnings growth for Asia as a region and support the equity market.
What do you see as the impact of China, both in terms of, do you want any kind of direct or indirect exposure while stimulus has been promised, but, progress when it comes to supporting the economy has been so painful to try and get to, right? Do you see that as being an opportunity? Do you see that as having, an outsized impact when it comes to some of the Asia adjacent or emerging market assets?
China certainly has been a very difficult market. The stimulus have been promised and there have been disappointments on that, and that's why the equity market has come under pressure. I think at some point of time, authorities will announce a substantial package, which could lead to a strong rally in the market, but the proof is in the pudding. So we need to see that stimulus package coming through. Meanwhile, I think market could remain range-bound, so investors should have selective exposure to China equity market. And the way we are advising investors to position is via the high dividend yielding stocks, given that bond yields in China are very low. On the other hand, if you look at some of the SOE stocks in China, they are offering dividend yield of 5 to 7% in Hong Kong dollar. So these names would be in telecom sector, banks, energy, etc. And we find them very attractive, especially compared to the bond yields in China.
How attractive will the Japanese market be in 2025, especially when we see more signaling coming from the Bank of Japan that they might hike rates later in the year or even next week?
We do see upside in the Japanese equity market, but the problem is that if rates are going to go up in Japan, the yen could strengthen. And whenever yen strengthens, it's normally negative for the broader market. So the way we are advising clients to position in Japan is to look at the rate-sensitive part of the market, especially financials, which are going to benefit from higher rates. Apart from that, exporters, I think, could come under pressure as yen strengthens.
What about the fact that we are seeing expecting a rate cut in the Bank of Korea today? We have talked a little bit about the semiconductor space, about tech in Northeast Asia, but given the expectations of a slowdown in the South Korean economy with the political pressures that they're facing, what is a broader market strategy here?
I think the Korean equity market is going to be more of a range-bound market because the earnings of the market is going to come down. If I look at the earnings estimate, every month analysts are revising their estimates because of the weak demand for a semiconductor, especially the legacy part. It's the AI part which is still doing well. So although the valuations are very attractive and there is supportive policies coming from authorities, especially the central bank, but given where we are in terms of the semi-cycle, it's difficult to see a major upside in the equity market. And not to forget that the monetary policy easing by central bank is going to put pressure on Korean won as well. So we see more of a range-bound market for Korea. And within the tech space, I find Taiwan a much more attractive place given the strong growth outlook.
Suresh, Tantia, it's good to have you with us of UBS Global Wealth Management as we continue to watch the markets today. One stock that we're watching is Takeda Pharmaceutical here in Japan under a little bit of pressure. We have heard from the U.S. FDA that they banned the artificial food coloring red number 3, which has been linked to cancer. This will not be allowed to be used in food manufacturing, but also some cold medicines, some drugs, and Takeda Pharmaceuticals of Vyvanse uses it for attention deficit hyperactivity disorder. So a little bit of downside there, Haidi.
We're still ahead, Shery. Goldman Sachs joining us to preview what, as we've been saying, could be the Bank of Korea's first triple rate cut since the global financial crisis. But first, we take a look at the latest when it comes to Hamas and Israel agreeing to pause the 15-month war. We are seeing celebrations after, of course, so much loss of life. A closer look at the deal and the implications next. This is Bloomberg.
"700 days of failure and 1 day of success." Well, we've had many difficult days since Hamas began its terrible war. We've encountered roadblocks and setbacks. We've not given up. And now, after more than 400 days of struggle, a day of success has arrived.
President Biden, they're speaking about the deal to bring a temporary halt to the war in the Gaza Strip. Let's get some more details now with our Bloomberg editor, Michael Heath. And, you know, there is a fragility to this agreement, right, but certainly welcomed, despite coming after such an elongated few months where we've seen such a loss of life on both sides.
Yeah, that's exactly right, Heidi. And I mean, it does seem fragile, but it also seems like there's whatever Israel is saying, that there is a degree of finality here. I mean, it's the deal is that it's from Sunday that for 6 weeks there'll be a truce that Hamas will release and its associated factions will release 33 hostages. Israeli troops will withdraw from sort of built-up, heavily populated areas, and Palestinian prisoners will be released as well. But the notion of going back to war, I think, is perhaps a little bit more distant. I mean, the interesting part in a way is that the deal seems to be very similar to one that was offered a few months ago by the Biden administration and was rejected at the time. And in the meantime, you know, you've had thousands of Palestinians killed in the fighting. You've had Israeli soldiers, quite a few Israeli soldiers killed there too, for not much gain, not much measurable gain anyway. So whether they choose to go back to that, I think, is a bit of a question. But the interesting part too is what seems to be the difference between that initial offer of this deal and now is the imminent return of President Donald Trump, President-elect Donald Trump. Just the fact that he is, I guess, so pro-Israeli that Israel doesn't want to get off on the wrong foot with him there.
What is the bigger picture here? You know, we've seen sort of building international support, and in fact, I think there's an ongoing global alliance gathering at the moment talking about the two-state solution. Is that something that's likely to be achievable or supported by both sides?
The logic of it is so strong, but getting there just seems so incredibly hard as well. So, would they get to a two-state solution? I think it hasn't happened in 75 years. Whether it's going to happen, imminently is difficult to say. But there can certainly be improvement. And the deal that everyone's looking at is an Israeli-Saudi Arabia normalisation. Basically, the two sort of key US allies in the region recognising each other and sort of forming a pillar of an axis that can sort of balance Iran and its influence there as well. Now, Saudi Arabia's basically said that it wants peace in Gaza, it wants the Palestinian Authority to take over from Hamas, and it wants a pathway to a two-state solution. Now, a pathway doesn't necessarily mean you have to get there, but there has to be some sort of concrete way to get there, and whether Prime Minister Netanyahu is prepared to go down that path. I mean, he's talked there's been reports that he's said, well, we could sort of finagle the language to work it towards that without really going towards it. But the general sense seems to be among the US that the Saudis want something a bit concrete here. So that is the bigger picture. That's what we're looking towards. That's what the Trump administration is going to be really interested in. But we really have to have things settled on the ground. And the difficult part here is that still it's basically Hamas in control there. So it's hard to see how that'll work.
Yeah, tell us what's happening on the ground, especially on the humanitarian situation, because at one point we heard that the United Nations was saying that it would not be really out of the question to conclude, and they have reasonable ground to think, that Israel was committing genocide.
Yeah, Shery, and it's been said by a few different groups, and it's on one hand, you know, Israel has the right to defend itself here. It was attacked completely unprovoked in that situation, and any state has the right to defend itself. There's an argument that says when you're going into a built-up area with a lot of civilians in it, and you're fighting a force that is using those civilians as shields, that there's going to be fallout there. The question is it reasonable proportion? Have they taken reasonable care about it? Israel is adamant that it does do that, and you know, truthfully, compared to other nations that have been fought these sort of wars, Israel does do very well. But the civilian casualties are massive. The destruction is huge. And there have been reports of various situations where, you know, soldiers may have overstepped the bounds. So it's really hard to say from this distance. But you know, they are facing a lot of pressure on that front. As to the aid, I mean, this truce does allow a ramping up of aid. But the difficulty again is because Israel has been really reticent to allow the Palestinian Authority to sort of be the main group now that will be in Gaza. So when you deliver aid, the question is sort of who does it go to? And it basically tends to go to Hamas officials or street gangs that then distribute it among themselves, and it doesn't get really to the people who really need it. You know, it supplies the black market and that sort of thing. That seems to be the issue here. So how they can manage that transition and get more reliable distribution of aid in there, as well as getting more trucks in there, is going to be the real crux of the issue in the weeks ahead.
What can we expect with the Trump administration coming in terms of not only humanitarian aid, but also just the Middle East dynamics at play, given perhaps a more weakened Iran?
Yeah, well, I mean, I think that the curiosity with President Trump is that he likes to take a hard line. He likes to display the sort of image of the strong man there. And to some extent, perhaps when it comes to the Middle East, particularly when it comes to the US dealing with Israel as its close ally, being a bit tougher doesn't seem to hurt at all. And one of the criticisms of the Biden administration was that they knew that Israel was often not being completely frank with them on situations or wasn't informing them in advance of what was going on. And Trump is probably likely to have less tolerance for that sort of thing and be prepared to wield a bit of a bigger strip because he's Trump, he's unpredictable. So he can do that, and he is known in the US, in Israel, as a huge supporter of Israel. So there's never any question about that. And so it's a little bit about sort of Nixon to China. He can do things that perhaps others can't. So it's going to be really interesting to see how that unfolds.
Bloomberg News editor Michael Heath there with the latest in the Middle East. Now, the U.S. has unveiled a fresh round of regulations aimed at keeping advanced chips from making their way to China. Beijing has called the Biden administration's flurry of trade restrictions in its final days in office irrational and irresponsible. For more, let's bring in our China correspondent Min Lo in Hong Kong. So, Min, what are these latest regulations?
Yeah, these are latest regulations targeted at chip companies like TSMC, Samsung. The onus is now on these companies to step up due diligence and scrutiny of their customers because the U.S. is stepping up licensing requirements for these companies unless their customers are approved or trusted ones who can show that their processes are below a certain operational performance threshold. The U.S. is also putting 16 Chinese companies that the Commerce Department says are working at the behest of the Chinese government to beef up China's chip industry. And the intention here is to close that back door to prevent the flow of advanced chips into China, because last year, for example, some of TSMC's chips somehow were able to find their way into Huawei's AI servers. And Huawei, of course, is a blacklisted company by the U.S. And so it's just the latest in a series of measures that the Biden administration has put in place to really tighten the noose on China's access to advanced semiconductors.
And, you know, unsurprisingly, we've seen a pretty unhappy response from Beijing. Does this really underscore how important it is that Beijing has been trying to kind of pursue some of the supply chain self-reliance in high tech?
Yes, so the Chinese Commerce Ministry has blasted the U.S., calling them irresponsible, saying that they're carrying out economic coercion and bullying. And yes, China has said it is vowing to double down on their self-sufficiency push. And already we have seen, for example, Chinese policies really focusing on beefing up the high-tech sectors, pouring in huge amounts of R&D money into its domestic chip innovation. And of course, this comes as we have seen every few days new measures from the Biden administration banning things like Chinese smart cars containing Chinese components or software, putting Chinese tech companies, the most successful companies like Tencent, CATL on a U.S. military blacklist. So a slew of measures here that the tensions are just going to intensify as Trump takes over the reins. There are still some ongoing probes, such as the ones into Chinese legacy chips that will only conclude by the time Trump comes into office. So it really puts into question how Trump will take forward this policy. Some doubts about whether he would repeal or reverse some of Biden's efforts so far, but given the bipartisan support and agreement that China does pose some sort of national security threat to the U.S., there is some expectation that the Trump administration will likely continue at least some of these policies.
Bloomberg's China correspondent Min Min Lo there. Some of the other geopolitical stories that we're following today, and Canada are said to be preparing to put tariffs on about $105 billion worth of US-made goods if Donald Trump carries through with his own trade threats. Our source says the list will only come into play if Trump moves first and may be expanded later, depending on what the US does. Prime Minister Justin Trudeau has met with the premiers of Canada's provinces to discuss the tariff issue. The Washington Post is reporting that President-elect Trump is considering an executive order suspending the looming US ban on TikTok. The app is set to go dark in the US from Sunday unless it's sold by its Chinese owner ByteDance. The Post cites unnamed sources saying a Trump order could suspend enforcement of the law for up to 90 days after he's inaugurated on Monday.
And coming up in the next hour, we'll have live coverage of President Biden's farewell address. This is Bloomberg. South Korea's anti-corruption agency will reportedly resume questioning President Yoon Suk-yeol on Thursday afternoon. Yonhap says Yoon asked to delay a planned morning interview citing health reasons. He was questioned for nearly 11 hours on Wednesday after being arrested. Investigators are examining whether his short-lived martial law declaration in December amounted to an act of insurrection. The political crisis is already having an impact on sentiment and the economy. In South Korea, we saw labor market conditions rapidly deteriorate. We are expecting the Bank of Korea to cut its benchmark interest rate today to 2.75%. We have more ahead. This is Bloomberg.
All right, we are getting just breaking data when it comes to the labour market here in Australia coming through. We have an employment change of 56,300 jobs being added to the economy for the month of December. The unemployment rate holding steady at 4%, so coming down from the 3.9% in November, but in line with expectations of 4%, just ticking up, I should say. The full-time employment rate seeing a fall of just under 24,000 jobs, and part-time jobs seeing an addition of 80,000. The participation rate just ticking up a little bit to 67.1 from the previous reading and from expectations there as well. So that sort of moderate job growth pictures, a little bit of an increase in the unemployment rate, perhaps unsurprising there, but we do know that the monthly data can be quite volatile as well. There is sort of always risks of swings, and it may not sort of generally point to a broader pattern there. But when it comes to the RBA, certainly we have had had a number of other data points, including pretty muted spending numbers that could add for more impotence for earlier rather than later moves from the RBA there. That labour force participation number at 67.1, at pretty close to record highs there. So really looking at the supply of new workers in the market. This is a picture when it comes to broader markets. We had a look at the Aussie dollar there, which has seen a little bit of upside today. US core inflation, of course, was the big one, where a bit of a sigh of relief for risk assets and investors, because it did show that perhaps a little bit of disinflationary force was taking place. That core number was the first step down in about 6 months. So we are seeing broad positivity on the back of that session on Wall Street. The Nikkei 225 putting on just over 1% there, and also some optimism despite the ongoing political crisis in Korea. And of course, it is Bank of Korea decision day, where there are a lot of expectations building for that third consecutive rate cut from the BOK. Shery.
Right, Heidi, let's turn to one stock that we're watching today, TSMC, reporting later, and is expected to post its fastest pace of quarterly profit growth in 2 years, reflecting its growing dominance of high-end chip making. Let's bring in Bloomberg Intelligence senior equity analyst Steven Sang. And Steven, of course, this is the main chip maker for NVIDIA. Another year very much centered on AI. What sort of numbers are we expecting?
I think in Q4, the market is expecting a very strong result reported by TSMC. Obviously, the Q4 revenue was released last week, and it's been ahead of expectation. And the street also expect the gross margin to come in near the high end of the company guidance, which is roughly about 58% or higher. And then we also have the pretty favorable currency environment, which is also in favor of the company. So overall, we do looking forward to a very solid set of results.
When it comes to the earnings call, what will you be looking out for?
A number of things, really. I mean, apparently, what's the company's guidance for Q1 and the full year? I think for Q1, the street is looking at single-digit sequential decline, which I think the street obviously kind of expecting the company can report the guidance, which is which is ahead of the seasonality. So we're looking forward to that. And then another very important thing is about demand. The AI is obviously the topic, and the investor are going to be very curious about what's TSMC's view on the full year's AI demand, and even other area like a smartphone or even the computing area. So that's a very important indication that the people are looking forward to. Also on the supply side, the company's capital expenditure going to be another focus, and also the overseas expansion and the CoWoS capacity. These are all very important topics that investors get a feeling about what's the management view on the potential upside this year. And then I guess the last but not the least is about the geopolitical issues. I think recently the U.S. seems to be adding more restriction or curbs on the advanced chips access to China. And then would that have any impact on TSMC's business? Will remain to be watched. I mean, TSMC, if you look at the first 9 months revenue last year, the China's revenue contribution was roughly 12 to 13%. So that's something that we may need to monitor, whether that part of business will have any impact.
Yeah, I was going to ask, when it comes to the geopolitical impact, what sort of signs have we seen already in TSMC business, given that we're also hearing that China has been trying to hoard a lot of components just in expectations of just harsher restrictions to come?
Yes, so certainly that will help the near-term momentum of the tech supply chain. But then mid to long term is really depends on how this measure going to be executed, because there's a lot of things can happen, and if the U.S. really wants to increase a lot of more restriction on the China's access to advanced chips, there actually will be a lot of impact, not just on TSMC actually, but also quite a lot of the U.S. chip makers, so such as NVIDIA. So the implication going to be pretty significant going forward.
Bloomberg Intelligence senior equity analyst Stephen Tseng there joining us with what to expect from TSMC as we continue to watch other movers across Asia and financials catching our eye right now because we're seeing a sea of green at the moment with CBA in Australia gaining about 3%. Other names like Westpac ANZ also gaining more than 2%. You can see Japanese financials also gaining more than 1%. South Korea's KB Financial gaining 1%. Of course, Haidi, we had some positive results in the earnings season kickstarted by U.S. banks, and some of the biggest banks showing really strong growth in 2024. That leading to the KBW Bank Index overnight surging more than 4%.
Yeah, let's get some more of those numbers for the big banks in the US. Our Bloomberg finance correspondent Harry Brompton joins us now. And there was a second most profitable year ever in 2024, only sort of outdone by the first Biden year in office. So, you know, they're so optimistic about the Trump era, but they're already doing very well.
Yeah, they're doing pretty well. It was a pretty stunning set of results overall. Citibank, I think 3 out of the 5 business units reported record profits. For JP Morgan, that was a record earnings by any US bank ever. Wells Fargo, their investment banking was up 63%. So yeah, really across the board, it's been a pretty solid set of results. It's been helped by the fact there were really no seasonality. I mean, often that fourth quarter is pretty slow, but because we're in an election year and it feeds through the point you were saying before with the first year of the Biden administration, the investment banks really do benefit from that kind of volatility and the uncertainty around the elections. A lot of people end up hedging and trading, and there's a lot of stuff that fills in those gaps for them. So, you know, that's obviously helped and been a tailwind, but even going forward, I mean, the share prices are reacting really well, and that's because analysts had some pretty bold expectations baked into these going forward, and even going forward under the new administration as well, based on the agenda set that many people are expecting under the next Trump administration, such as deregulation, tax cuts, and just continued GDP growth that will help the revenue for the banks across the board.
Yeah, in Jamie Dimon's words, many bankers were dancing in the street after the Trump election victory. So, I mean, how much looser does regulatory standards kind of get, or compliance get, right?
Yeah, people are quite optimistic on the back of that. I mean, we saw tax cuts and that general agenda happen, and a business first agenda really take place under the first Trump administration. How much can that keep going? I mean, did they pick the low hanging fruit the first time around? But no, I mean, there's a lot of expectations that generally even the capital rules can be slackened, and that can be a real flywheel for banks in terms of earnings and profits over a medium term. So there's that element. I think it can cut both ways. We've still got there's a lot of uncertainty, a lot of time to go, and if there's anything we learned from an earlier Trump administration is that there's a lot of volatility. Now, aspects of the investment banking and the big banking business, such as deal making in particular, whether it's mergers and acquisitions or ECM activity, debt raisings, and especially IPOs are the most kind of volatile averse spaces. So it's not unusual to see Trump, and we've even seen it with some of the geopolitical stuff lately, where it's it's games, it's brinksmanship. That doesn't help with people's feeling of certainty around doing business and costs of doing business. So in my view, it kind of cuts both ways, but certainly at the moment, people are taking what they can from this and definitely breathing at least heightened expectations in what they would have seen under a Biden administration.
Good thing that you're mentioning some of the potential risks ahead, because there seems to be a lot of excitement and optimism about this year. But then I guess the question is, what happens if you're already priced in for perfection?
Yeah, so I think Shery's question really very reasonably asked what happens when you're already sort of priced for perfection, right? What's the downside case? What are the risks?
Yeah, some of those downside cases, I mean, even going into this, we saw a surprising inflation print as well. So, we're still in this era where central banks perhaps haven't got inflation fully under control. And what are the expectations around that? What does that do for, GDP growth across the United States, as well as, those elements around the Trump program and, exactly how influential they can be, whether they've picked the low-hanging fruit and as to whether there's any elements there that become problematic in terms of uncertainty around the governance and the way of doing business, not just for banks but for business generally that feeds through to the bank earnings.
All right, now we're Bloomberg's finance correspondent Harry Brumpton there in Sydney. Now, President Biden is to deliver a farewell speech in about 2 hours as his administration comes to a close ahead of Donald Trump's inauguration on Monday. Bloomberg's political news director Jody Schneider joins us now from Washington. So, Jody, what will you be watching out for in this speech?
Yeah, and this will clearly be a legacy speech, but it'll be interesting to see what he highlights as his legacy. We think that it's going to be economics, which is interesting because he, of course, did poorly with a lot of voters on the issue of economics, particularly inflation. But he is expected to tout job growth, which has been substantial during his tenure, as well as kind of getting the economy in the country back on track after COVID. When he took over in early 2021, it was still in the depths of COVID, and there were supply chain disruptions and all kinds of disruptions to people's lives. And I think he'll talk about that, how he tried in his administration to bring things back to a sense of normalcy, to growth, to job growth, and also things like his legislative accomplishments, the Build Back Better program, some other kinds of things that he will say, he is expected to say, have helped everyday Americans. At the same time, what things he won't say are probably that he is highly unlikely to point to his very low job approval rating. It's 36.1%, which is the lowest at this point of a presidency for any U.S. president since Jimmy Carter.
It's felt like in these last days there's been something announced, something signed, something sort of put through every day, right? It's been a really busy end for this administration to try and, I guess, make changes that could affect beyond when it ends its term in power.
Yeah, in a few days, Donald Trump will again be taking the presidency, something, of course, Joe Biden and Kamala Harris as vice president very much did not want to happen. So they've been trying to do what they can in these last few weeks on things like energy and on some regulations and other things that may be turned back by Donald Trump very early in this presidency, but they've been trying to do that in the final days. And, of course, the ceasefire in Gaza and trying to get back those Israeli hostages from Hamas is something very much that Joe Biden has been trying to do for months, but certainly the last few weeks ramped that up. And he is almost certain to point to that in his closing remarks, his farewell speech tonight from the Oval Office at the White House.
Bloomberg's political news director, Jody Schneider, and in fact, we'll be bringing you live coverage of that farewell address later today. This is Bloomberg.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now.
We're not going back to 0% kinds of normal rates, but rather those low single digits. Is it 2% or 3.5%? It's someplace in there, and we're moving into the range.
If you look over the last 3-4 months, we're basically running at around 2.5%, which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Some of our guests weighing in on the latest U.S. CPI numbers and its implications for Fed policy, and that surprise inflation slowdown in the U.S. actually wiping out the losses for the S&P 500 for this year. We saw gains in stocks and bonds alike. Take a look at how South Korea is now following that upside, with the Kospi gaining 1.4%, the Kosdaq 1.6%, the Korean won holding steady. But of course, all of this ahead of that potential rate cut coming from the Bank of Korea. The expectation right now from Economist is that the Bank of Korea will cut rates to 2.75%. This would be a third consecutive rate cut. In fact, our next guest, who joins us from Seoul, Goohoon Kwon, also expects a cut today. Senior Asia economist at Goldman Sachs joining us. Thank you so much for your time today. So what makes it more likely that we will see this rate reduction today and not in February?
Yeah, our expectation is that the majority of the MPC members to consider downside risk to growth to outweigh upside risk to inflation.
Tell us a little bit about the transmission mechanism for the economy and why the South Korean economy needs this.
Yeah, when you look at some of the early indicators for consumption, it was quite weak and subdued. We have some uptick in the export in December, but we think that's mostly coming from like a front loading of Korean export to U.S. before the start of next administration. We have seen similar things to Taiwan export in December as well as China. So that's more or less temporary uptick. So going forward, we expect a very tight fiscal policy or fiscal the budget for this year, which was passed in a hurry at the end of last year amid the political crisis. Also, the tariff risk, which would weigh on investment as well as export from Korea, would like to put the downward pressure. Our growth forecast is 1.8%, which is below consensus. So far, we are holding on to that, given the formation of the interim government and also the reduction of the the political tail risk. We have to see, however, how that play out, especially next week when the Trump administration start and they come up with the tariff measures.
Kwon, I was really surprised to see the jobless rate surge so much for the month of December. Is that already because of sentiment being hit, especially with the ongoing political crisis, or were there some idiosyncratic numbers that really led to that labor market condition to deteriorate so fast?
Well, when you look at the trend of job growth,
Kwon, let me just interrupt for a second, because we are actually getting the Bank of Korea's rate decision today. Oh, surprisingly, they have not cut the rate, and they have left the policy rate unchanged at 3%. This was really not foreseen by many economists. Only 4 of 22 economists surveyed by Bloomberg were expecting the Bank of Korea to hold steady, not cutting the rate to that 2.75% that was expected. So again, the Bank of Korea leaving the rate steady at 3% after 2 consecutive rate cuts. This despite the fact that we continue to see signs of perhaps a weakening economy. And as we were talking with our guest Goohoon, the political crisis also spilling over when it comes to the impact on broader demand. So Goohoon, first of all, give us your reaction to what the Bank of Korea is doing right now, given that you are also among those who, the majority who thought that they were actually going to cut. What could be the rationale here?
I guess they have probably more recent numbers, and maybe the numbers for Q4 might have been a bit stronger than they expected, or despite the weak sentiment data, maybe actual numbers not as bad. But in our view, going forward, we thought that it would be more prudent for them to cut and wait rather than not cut and then wait for the evidence of weakness. But obviously, that's their judgment. And the fact that they took so long, unusually long, for them to make decision suggests that it was a very close call. So we expect this to be dovish hold rather than hawkish or neutral hold.
Yeah, it's interesting. When you take a look at swaps markets, traders were not pricing in any cuts at all. So if we assume that maybe this is also sort of the oncoming risk of Trump trade tariffs and the impact on South Korean exports in particular and the won, does that also suggest that we probably will see a cut in February? Bloomberg Economics was pretty 50-50 as to if it was going to be a January or February cut.
Yeah, I mean, we have been saying that the inflation has been trending down and export has been subdued. And then on top of that, the political risk and also associated declines in investment or broad economic activity would like to weigh on growth in a way to push Bank of Korea to cut as a precautionary rather than waiting until the evidence of weakening. But to the extent that they decide to hold, the rate seems to suggest that maybe they have confidence that strength of activity will continue, and then maybe they judge that ongoing political turmoil has been kind of ending with the political calendar kind of lined up until there is a new election, snap election, sometime maybe June. Yeah.
Household debt for the longest time has been one of the biggest sort of systemic concerns for South Korea's economy, right? With the loans coming down, obviously perhaps, trending in line with a loss of confidence amongst households. Do you see this as being a structural shift?
Yeah, when you look at the recent housing market data and the household debt growth, there is clear evidence that it has been going down. And we thought that financial stability concerns of Bank of Korea, which was the main criteria when they decide to, the pace of the easing, looks like things are under control and in a way to allow them to cut the rate. On top of that, obviously, the Fed, stance has been changed a little bit given very strong job numbers. Maybe that, pushed some of the members to, wait and hold. But we now view that, the start of strategic hedging by MPS on the top side of dollar Korean won to protect their asset returns in Korean won would have allowed the Bank of Korea to be less constrained by U.S. monetary policy or rate differential.
Kwon, who's a senior Asia economist at Goldman Sachs. Really great to have you with us as we continue to get analysis on your Bloomberg. You can turn to for the BOK decision with that surprise hold after two back-to-back cuts. TLIV Go to get that commentary from our expert team of editors dissecting that news at the moment. We also do have some breaking news when it comes to another story we're following. Scott Bessent, who is, of course, President-elect Trump's nominee for Treasury Secretary, set to emphasise the importance of maintaining the US dollar as the world's reserve currency. He'll also be discussing securing supply chains, deploying sanctions to address national security requirements as he appears before the Senate Finance Committee for his confirmation hearing. He is expected to get that approval very easily. It's quite interesting given that we've seen US facing sanctions fatigue from both allies and adversaries. The dollar rule, of course, is a deeply entrenched one, but there is the BRICS bloc that are mounting a challenge to this dollar-based system. And we have seen Bessent as being a proponent of realigning US currency policy. But of course, this is just one of the unknowns going into the next 4 years, Shery.
And really in line with some of President Trump's comments earlier as well when it came to the supremacy of the dollar, right? President Trump, of course, assuming office on Monday. But before that, we have special coverage of President Biden's farewell address coming right up, followed by the China show. This is Bloomberg.